What's up, everybody? Welcome to the Daily Stock Market Brief. Today's date is October 22nd, 2020. If it's your first time here, welcome to the show. I typically have a camera on, but I want to get this video out a little bit quicker than usual, and I think that if I take off the video, I think I'll be able to upload it a little bit quicker. So typically what we do in these videos is we look at a bunch of different charts, the indices, indicators, commodities. Today we're going to be looking at the 10-year yield and also the US dollar. If you would like, there's going to be timestamps in the description as well as links to these charts and the chart deck as well in the description below. We're going to be using technical analysis to really kind of get a good idea as to where this market might be headed. Let's start off with the first section. We're going to be talking about the indices. Now, really quick, what I want to kind of talk about today is the bullish case of what's going on with the price action. And to me, once we get into the indicators, which we talked about yesterday, is you're going to notice some interesting behavior kind of going on. And what I'm starting to see and what I'm starting to envision here is a bullish case for the price action. However, when we get into the indicators, you're going to notice some interesting things where it could, yes, it's showing us that we can have room to go further up and potentially break out to even all-time highs, or maybe even the double top, which I hear a lot of people say, which I'll talk about. But it's setting the stage for a potential bull trap. And that's what we're kind of really focusing on today, along with the risk management piece of it, which is also extremely important. But let's go ahead and get into it. But I want you to keep that in mind. Price action's looking bullish. Some indicators suggest that we could go higher, but it could easily get overextended very quickly. So let's talk about it. This is the S&P 500 on the daily time frame. And I really just kind of have this bull flag, boom, boom, and we're kind of in this pullback moment. And the neckline, it held up from this previous inverse head and shoulder, which we're kind of mapping out in other videos. And look where we bounced from. We bounced right from the 20-period moving average. Now, I want to stress this for all those trend traders is, first off, you want to make sure that, one, the price action is above the 20-period moving average. And then as far as the simple moving averages go, you want the 20 above the 50 and the 50 above the 200. And as you can see right here, the 20-period did just cross above the blue. That's good. You have a nice hammer candle. And we recaptured the 5 EMA on the daily time frame. That's that shaded gray line right throughout here, which is good. Now, one last piece that we need to do and ensure is that we get above this upper trend line right here. If we start seeing a break above that, that could be very good where we can see a push up higher, potentially even into this gray shaded box, which was the all-time previous high, and there's a gap window up there. So I can see that there can be some hesitation up in this area, but a move from here up to here is a pretty aggressive move. So we got to keep our eye on the prize here. So we're going to get into a smaller time frame. Let's look at the 2-hour. And you can see here I formed out a cup and handle. Here's the two shaded gaps right below us. And as you can see here, the price action is not above the 20 period, and the 20 period moving average is below the 50 period. And then you have this upper trend line here. So the 2-hour time frame has some work to do. If you look at the MACD, though, the MACD looks like it's getting ready to do a bullish crossover and then potentially start heading above zero to see a trend move to the upside. So this is kind of my strategy is, one, I'll play a breakout to the upside, or I'll play a buy the dip down here in this range, which I'll show you more on the 30-minute time frame. So here's the 30-minute time frame. We discussed this on yesterday's video, this gray shaded box. That was going to act as support. And what do you know? We opened up. Nice hammer candle right at the gate. Then we kind of tracked sideways. So the green shaded box, it acted as support. We usually call that the bull's camp. And what we saw there from the rest of the day is it kind of retook the 5-period moving average, and we just started heading up higher into this upper trend line. Now, what's very interesting here was it did have a positive divergence. It didn't reach quite down to the bottom portion of this channel, which it still might. You know, it could get hung up right over here. And then we have also 3480 as well, which is an area of resistance. But we had a low here on the RSI and then a higher low here. And as you can see on the price action, we had a low here, but then we got a lower low here. So that was the positive divergence that I was talking about where it came into this area. I was hoping it'd stretch down further, but it didn't. And then we saw that move to the higher place. So we got to wait and see if we can get that breakout. The price action is right on the 200-period moving average and also the 5-period moving average. So we're just in this very tight coiled range. if there's news around stimulus, which it seemed like there was good stuff going on today or progress being made, always pay attention to the possibilities of a rug to be pulled out from underneath our feet, because once we get into these areas, we might head lower. But like I've been saying, this could set the stage for a bull trap, meaning we start breaking out to higher highs, everything looks good, but then all of a sudden some of our indicators get overextended and they're not looking too hot. And then all of a sudden we pull back. And it doesn't mean that a bull trap will send us all the way, down to, the March low. There's a possibility of that taking place. But, I would only see that really happening if, the economy gets shut down again and there's this massive wave in COVID spikes. So, we got to pay close attention to that as well. But as I see it right now, price action is looking pretty bullish all around. Here's the NASDAQ 100 cup and handle. We filled one of the gaps today, formed the hammer candle, sitting at the 5 EMA. We've been doing that now for, 3 trading days. Very similar. We got to get above that trend line right here to see a potential breakout to the upside. And if we do get above that, we can get 200 points pretty quick. And we still have a couple gaps below us. And we have this bearish crossover. It's above zero, so you can't hold too much weight on it. But yeah, price action is looking pretty bullish so far. Here is it on the 30-minute time frame for the NASDAQ 100. And here was the price kind of trade idea that I was talking about a couple of days ago. The positive divergence took place. We had the low into the channel, hammer candle, bounce, boom, from 11,525 up to 11,675. So if you caught that, congratulations. And look where we ended up at, right at this lower trend line. Once we broke it, it then becomes resistance. It was support, now it's resistance. We're still below the 200 period, so we have some work to do to move back up into the upper range of this channel. What I plan to do is continue just the narrative of when we break out and the trends look good, that is when I will place a trade to the upside. If we come back down, I'll buy a trade down here as well. As I see it, I am only going to get short if we get extremely overextended in both the price action and the indicators. But the price action right now is not overextended. It's consolidating and it's moving lower. So we got to pay attention to have everything align. Here's the Russell 2000. Won't spend too much time here. Bull flag, nice day, up 1.73%. What's interesting is the Russell 2000, the small caps, have been performing very well alongside utilities, which is interesting because utilities are a risk-off play. And small caps, are more risk on. They mirror what's going on in the economy. So when we have, small caps doing good, the sentiment of the economy should be pretty positive. But then we have the utility sector outperforming for the last 7 weeks, and that is a risk-off type of thing. So there's just some weird things taking place in the market, and it all leads back to all this uncertainty. Now here's the Dow Jones, falling wedge or a bull flag, bull pennant, whatever you want to call it. Pulled back under the 61.8% retracement level. Hammer candle formed, just like these inverted hammer candles. So, the story's the same. If we break above and out of this, we can head higher. Now, keep in mind, we got to get above these other previous candle wicks. I would say above 28,600 to really confirm that move. And if we start breaking below this previous day, we'd start heading into this 50% retracement level. That could act as a level of support. The MACD, bearish crossover, but it's still way above zero. So yeah, it can cross back over. You can't, it's worth noting, but you don't want to put too much weight on that. So everything's setting up for a move to the upside so far. Now let's talk about the indicators though. First, I want to talk about the VIX. Remember this gray gap down here? The shaded box that's been bugging me so long? Well, you never know. If we break out to the upside and it's, just moves and moves up to an all-time high, there's a possibility that this inverse head and shoulders pattern kind of just gets depleted and we fill this gap down here. Maybe, maybe not. However, we are still in this inverse head and shoulders, and we've been tracking sideways within this channel. Yes, we came or inverted hammer candle. We mentioned that yesterday, and then we saw this down day today. So it looks like it's positioned to move lower into this channel. We'll see. Like I said, if we get the rug pulled out from beneath us and they say a hard, no, put the kibosh to stimulus, or there's a massive wave in, second wave in all these coronavirus cases, we might see this thing spike up of this neckline and move into, 50 to 70. Who knows how high this thing could go when volatility really increases. Here is the S&P 500, but I have a couple indicators here. These are different from the ones that I showed you yesterday, but I kind of want to just really quickly go over this and kind of explain why there still could be more room left to run to the upside. First off, here is the CPC smoothed over 10-period moving average and 10-period DMA. And what I want to show you is this is first inversed. So when this price sinks down here to these like really low levels, I'd say about 120 or 1.2, okay? Boom, if you look across, 1.2. When it hits these levels, that is considered dumb money, overextended buying puts. So they're buying puts at the wrong time, and then boom, we move to the upside. And you can see that on the ratio. The lower it goes, which is technically higher, 0.75 all the way to 1.30. So 0.75 means, hey, everyone's way too bullish or way too bearish down here. Now, as you can see, when it gets up to 0.8 or even a little bit higher than that, you can see if you just look up, that was a lot of bullish momentum right here. So a lot of dumb money was buying calls at the exact wrong time. You saw that right here too in mid-June. Boom, a lot of dumb money buying calls, and boom, we saw that downdraft. Saw the same thing over here in February. Boom, huge move to the downside, right? Over here, you saw the same thing. Boom, you look up here. Boom, downdraft. Why do I think that there's more room to go? Well, first off, we're only at 0.85 right here on this indicator. And, to really get overextended, I think that we need to move a little bit lower, quote unquote, higher to 0.8 up in this range. That would indicate to me that this is looking like there's a lot of dumb money buying calls and it's pretty overextended. So we have room to continue to potentially move. Now, when you look at the CPC, which is just the equity side of things, yeah, retail traders are more bullish than ever right now. So this kind of feeds to the narrative like, yeah, if we get a squeeze higher, it's going to bring in more bullish behavior and potentially extend this even lower or higher, what I should say, to 0.45 and maybe even higher than that. And as you can see, when it reaches these levels, they're buying calls at the exact wrong time. So we have room to get overextended still in these markets. Here is the CPC smoothed over the 10-period moving average. This is just kind of, zoomed in here, and we use this as a sell signal. We're still floating sideways. We haven't crossed back above, but this is what I'm talking about. We have room to go, right? We can still move higher in the S&P 500, and then potentially then we can see the crossover, which is the sell signal. We got to pay attention to this. When it crosses, doesn't mean that the price action is immediately going to fall down, but what it does mean, what we've seen before is we've seen it price action move a little bit higher than down, but then potentially even lower. So you can see it. We crossed above here. If you just look straight down, it was right around here. We bounced around, moved up. Everyone's like, no, that doesn't work. And then boom, we got that leg lower to about 3,200. Okay. And then what we got to do is use our technical analysis, support and resistance, and kind of just overall other indicators and just see what the sentiment is to find out where the bottom might be. All right. And then we crossed over here, the same thing, we started going higher and everyone's like, no, that doesn't count. Where's all the people that said there was a sell signal? And then boom, to the downside, right here, boom, to the downside, right here, boom, to the downside. So the indicator's pretty darn accurate, and you can extend it further back if you'd like. All the charts are linked in the description below, as already previously mentioned. Here's the NIMO. This is pretty interesting, right? We're back to positive breadth, 0.63, not by much. We're floating around zero. And this looked like 2018, right? All this negative breadth right here, you look straight up, we hit all-time highs. Interesting, right? And then we saw the big downdraft finally take place. And then we saw this very steep increase. And now we're seeing it back down to negative breadth. Now, what's interesting here is you look at 2018, same thing happened. Negative breadth, okay? Boom, to the downside. What happened? Well, we saw this big spike, just like here, big spike. What did we see take place? Well, we saw it run up, all right? Boom. We saw it run up. But then what happened? Well, we came into a negative breadth, but not that much negative breadth. And then we spiked back up again. So we came up, we came back down, very similar to what we see here. Came up, came down, but we didn't get down just as low. And then we spiked back up pretty decently, but not as high as the previous one. So what I'm thinking here, if this does play out, because it's still within the pattern, yeah, if this bull flag does start breaking out, maybe we go retouch this high or maybe even potentially higher, right? History doesn't always repeat itself, but it rhymes. I think that's from Mark Twain. So if we start getting up higher, maybe we got to watch this level right here at 0.5 or 0.4. Maybe we get that positive breath, but it moves the market up, but not quite as big of a breath over here. And then all of a sudden we see that spike even stronger to the downside. And then boom, that's when it crashed through this level of 3250 down, down, down. That could really bring us to that original target I was talking about was 3,000 to 3,100. That would make some sense. I would say wherever the 200 period moving average is, we got to pay close attention to that because that can act as a very solid level of support. And as far as the price action goes, the longer it stays above it, the higher the 200 period moving average move. Here is the NASDAQ 100% of stocks above the 200 period moving average. So this just tells us what percent of stocks in the NASDAQ 100 are above the 200 period moving average. Okay, so when things get really, really overextended, it says to me, 90% of the stocks, when we mentioned it over here, were above the 200 period moving average. And when we see things like that move aggressively to the upside, chances are there's resistance up ahead in a lot of those stocks, and we see the pullback. And what did we see? Well, we saw it reach this level. We saw the stocks pull back. I still think that because it's been bouncing around here, we still have potentially room to go. And you look at the RSI is down here at 54. If we see a sudden spike to the upside in overbought territory above 70, that would tell me, okay, things are getting way too overextended here. That's when we could see the pullback. So if we break out of a bull flag here, we get squeezed higher to maybe a double top or potentially even go higher than that. I think that this is going to get way too overextended and our volatility is going to increase quite tremendously. So there's just room here to potentially go because I see it as the RSI is not overbought, not oversold. It's right there in the middle. We got to just look for these extreme levels and the velocity at which these price action moves. So when we see big spikes to the upside and we see potentially moved into overbought territory, that's when we could see that sharp declines. Now, when it gets to this level 90, yeah, I mean, we call that an overextension because you look back in the history of the chart for years and it hasn't reached those levels. So that to me was also an overextended move. Here is the NASDAQ 100 bullish percent index. This right here is based off of what's called point and figure charts. And it just tells us, how many stocks are on buy signals versus sell signals. And if you look over here, we're at 69. That means 69% of the stocks in the NASDAQ 100 are on buy signals. And we called it out right here when the RSI was overbought. We're like, okay, this was a very rapid move up to this overextended area around 85. It'd be likely to see a pullback. Now, why do I think that there's still room to go? Well, we can still head lower down into this 50, but that would still be technically in this bullish range. The RSI is not telling us, it's overbought or oversold. So we just need to wait for these overextended moves to really help us make a decision as to where the price action might go next. I like using these indicators as contrarian indicators, but I like looking at overextensions and bullish or bearish divergences. As you can see here, we had a bullish divergence. It was way down here, 2.5, which told me is like, okay, this move is overextended. We're going to see it ramp up. And then what do you know? Over here, March bottom, boom, we saw it move to the upside. Yeah, right over here, we're at 85. Things were really bullish. You can see right here, negative divergence. RSI said, hey, the market's saying that this is going to head lower. The price action is kind of trending sideways. Boom, we went lower. So I mapped out some of those divergences right here. We mapped that one out and we saw that move to the upside as well. Let's talk about some commodities. Start off with gold. Gold looked pretty strong yesterday and lost all of its gains, pretty quickly. Still above this trend line that's kind of sloping down, and it's still below the 50 period. We were kind of saying this looks like something that could just draft down, draft sideways until there's a catalyst to either move us higher or to move us lower. I like the price action sitting here. The higher this 200 period moving average goes is better because that's going to act as some sort of support for us when the price comes down or if it does come down. If we start breaking down lower, yeah, I do think that if we crack below 1850, we're going to come down here to this previous support, this breakout zone 1770, and that's probably where the 200 period moving average is going to be at. I'll be a buyer down here, and I'll be a buyer if we start changing the trend here because it's a short-term trend right now is lower. So we need confirmation. We need it, one, to get above the 50 period moving average, above the 20 period moving average, and we'd like to see it also hold above, 1950 to 1980 where this previous is because first off, it's been making lower highs, and we need to make a higher high and higher lows in order for the trend to change. Here's silver. Silver's just tightly coiling up. There's going to be a catalyst here. I don't know what it's going to be. It's either going to send it lower or we're going to get higher. If the dollar breaks down, we're going to see this go higher. If the dollar breaks to the upside, or breaks out, I should say, we're going to see this get pushed lower. And where can it go? Well, it can go to 22. It can go even down to this 200 period moving average. We got to just pay close attention to these levels. I'll be a buyer on a breakout if we start getting, above these levels. But if we start breaking down, I'm not buying until this 200 period moving average. I think that would offer up a very, very good risk versus reward trade. Let's talk about Bitcoin. Bitcoin's been getting some attention as of lately. This is the log scale on the weekly time frame. I just wanted to kind of show you, dating back all the way here for 2017, late 2016. Symmetrical triangle, we broke out recently. We're seeing it head higher. We talked about this on the daily time frame. I'll bring up a daily time frame here in just a moment. We are running into some resistance right here. Okay, the price action is at 1346 or 13,046. Previous resistance was right here, and then obviously the all-time high was up here. There's a lot of hype right now about this, so everyone's just getting super happy. But keep in mind, the move's overextended, and I'll show you on the daily time frame, but when the price action gets to overbought territory, we can see 1,000, 2,000, 3,000 point swings in a single day. Here's the daily time frame. The last time we talked about this was this symmetrical triangle. We said that, hey, if we break above this, break above the 50, and then hold above 11,200, that was the big piece there, okay? 11,200, we finally got above it, and you can see we just tracked sideways for a couple of days, and then finally price action took off on us. Boom. So it broke out, consolidated, and then really moved higher. Very overbought, getting frothy. Doesn't mean it can't go higher, but keep in mind, it can get very volatile. When you look over here, when it got this frothy, this day right here swung from 12,200 to a low of 10,800 basically. So yes, it can get very volatile when the price action gets up here. But if you see a big downdraft, that doesn't mean that it's going to crash. What that could mean is the RSI is going to get back to normality, and then we can consolidate and then potentially have our next leg higher in the price of Bitcoin. Let's talk about the 10-year yield. This is also getting some press. The 10-year yield has been moving up. It's been breaking out. Now, what have we been saying on previous times we talked about this? First off, I said, it looks to me, I was short-term bullish because the trade looked bullish. However, long-term bearish because the trend is bearish. Now, interestingly enough, we have the 10-year yield running into the 200 period moving average here. This is interesting because what happens if we start breaking above it and then start shifting this trend? Now, this move is good for banks. You can see right here, we have the 10-year minus the 2-year. When this, first off, we were inverted over here in September of 2018. When you get yield inversions, that's an early signs of recession. And what do you know? We got the recession. Call it what you want. Call it crazy. That was the coronavirus. Boom. Rates got compressed. Now you're seeing the spread move higher and higher between the 10 and the 2-year going up. This is good for banks. Why is this good for banks? Well, banks borrow short term and they lend out long term. Now, rates are all relatively pretty low, and I'm still pretty bearish at these levels. 0.87, that was a big move today. Pretty darn big move today. Now, we're running into the 200 period, like I said, and then also this previous spike where we got rejected from. It's going to be interesting to see where this goes. I don't know if this is going to continue to move up. You got to think this sentiment here means that people are risk on right now. So when yields go up, the 10-year note and bonds, right? When these yields go up, bonds become less valuable, which means nobody wants to buy bonds or notes. So when we see this take place, it's telling me that, hey, investors want to go risk on. So if we do start breaking above this 200 period moving average, that can help shoot the S&P 500 up a little bit, but you got to pay close attention to when this starts reversing. Because you gotta understand this chart has been just sinking down for since 1985. You just look at a trend and it's just been going lower and lower and lower and lower. Let's take a look at the U.S. dollar. Here's the U.S. dollar. Pretty decent day today. This is considered an inside trading day. It could also potentially be a bullish sign. These two candlesticks down here. I don't know. I'm not going to put too much weight on it. I created this inverse head and shoulders. I have not seen anybody talk about the inverse head and shoulders possibility here other than the basing pattern that's been forming. And yes, it could still be a basing pattern or a channel just tracking sideways for potentially the next move lower. So we got to pay attention to both things. Yes, there's a case for the bulls, but right now it's more bearish. Why is it more bearish? Well, first off, the trend. You got to pay attention to the trend. 50 period sloping down, 200 period moving average sloping down, price action below the 50 period and below the 200, big spread, a lot of work to do for the bulls in this case. However, we're range bound, 94.5 all the way to 92. We're more towards the lower end of this range. If we get down here, we might start seeing it move up, potentially get even squeezed to the upside, which is going to put a lot of pressure on equities, and that's a big possibility. However, if the dollar keeps getting crushed, we break this neckline of this inverse head and shoulders, and we're gonna have another leg lower. It's a big possibility that we get another leg lower, but we need confirmation there. And if we do start breaking down there, then gold and silver is going to look very, very attractive. All right, everybody, that's all I have for you on today's daily stock market brief. Sorry that I don't have my camera on. I don't know if the only sad part is I can't show you Coco, but hopefully I can get the video out sooner. And I have been working on my website. The website is looking pretty darn good. I can't wait to get that out so then I can just include you guys on my email list when I have stock picks and I can walk you through it. I have all these cool plans and set up, but I'm a one-man shop right now, and it's quite difficult to navigate all this stuff and figure it all out for my really honestly first time doing it. Overall, just to wrap our head around this stock market brief, the stimulus is still around us, okay? The spooky stimulus deal, is it going to get passed? Is it not going to get passed? We can get the rug pulled out from any second, right? Which could be very bad for the presidential election for Trump. I feel like that's a little trick that Nancy Pelosi might do for some weird reason. I don't know. I'm just pessimistic. It's completely speculative. But, if something does, if they manage to hold this kind of facade, the price action looks pretty good, so we can have another leg higher. But keep in mind, the indicators, they have room to go, but they can get overextended very easily. So this is a uncertain environment. It continues to be, Russell 2000 looks pretty strong. That's small caps. Interesting. That means they feel like the economy is going good. You see yields moving up. This is interesting. What's going on here? Okay, so really we just got to pay very close attention to all these signs because things can reverse very quickly. Manage your risk. Pay very close attention. Don't let, a day go by where you kind of just, no, everything will be fine, because the moment that something happens in this type of market could be very, very fast and very, very volatile. That's all I got for you guys. I will see you on the next market brief.